Valens Research, Uniform Financial Analytics.
So if we look at Wyndham, right? Wyndham, for those of you who don't know, obviously, so Trade Desk, sorry, for those of you who don't know, is a advertising platform, an online advertising platform. So the next company we're going to look at is Wyndham Destinations. Wyndham Destinations makes timeshares, right? They build timeshares and then sell them. It is an incredibly stable and boring business, right? As you can see, even looking at the returns on a true blue uniform accounting basis, it's basically been a 10% ROA business plus or minus the last 10 years. Even when it went from having a hotel business attached to it to spinning off that hotel business, returns incredibly stable. However, even though returns have been incredibly stable, because of the debt and valuation of this business, this company isn't trading at a 19 times multiple. It's trading at a 63 times multiple. For those of you who don't know, the average PE in the market right now on either a uniform accounting basis or as reported basis is around 21 times, give or take. This company is trading at 3 times that level with returns that are stable, not improving, and modest growth. In fact, shrinking in many years. That makes zero sense. For this company to be fairly valued, you'd either have to expect that it's going to continue to shrink and see returns double, or if you think it's not really going to shrink anymore, but after shrinking massively in 2020, because it is a timeshare business after all, it's basically going to be flat growth for the foreseeable future, you would need to see ROAs rise from around 10%, where they are right now. You would need them see them rise to 15%, 14 to 15%. That is 50% higher than they are right now, and this business has ever sustainably done historically. That looks completely irrational when you think about the fact that really this business here was a higher fundamental ROA business than it is now because of the fact that it had a lower asset intensive hotel business attached, and now it's just timeshares. If you look at this on an as reported basis, you'd say, oh yeah, it's trading at a 19 times multiple, but that's okay, it's on low earnings. So basically the market's saying, yeah, you are a market average company. That kind of makes sense. If you look at it on the real, true numbers, you would see this company is trading at 3 times market average valuations for a business that's going to have serious headwinds for the next year. And after the next year, it's still not going to be a high growth business because timeshares aren't high growth.
Valens Research, the world's leading source for uniform financial analytics.